Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we're back here on the Investor Coaching Show. I'm Paul Winkler. She's Arlene Brown. You know, I haven't had a week where I didn't do any prep for a show in a long time. It's kind of a fun week for me just to go, we're going to do the basics. We're just going to walk through the stuff that, you know, you just may not quite understand, but the more you get this stuff, you don't have to know everything, but the right things is pretty doggone important. And, you know, a lot of times people say, are you just going to teach me how to invest? And you know, because there's a lot of stuff I'm not going to talk about today that gets really a lot more detailed. You know, like how you use momentum in the vesting process and securities lending revenue and how, you know, when profitability factors and how you apply them in the investing process. You don't need to know all that stuff. But there are certain things that are super, if you do what we do, you need to know it. But and unfortunately, when I was working for the big investment firm, didn't know any of that stuff.
I did not. That's why I ask you, are you talking about sector or asset classes? And you said asset classes because I never knew asset classes before.
Oh, yeah.
Because the way I was taught
that's
was
interesting.
all sector.
What an interesting insight, Arlene. Okay, so yeah, you didn't even know what an asset, and I guess I probably didn't know what an asset class was either. Yeah, now that I think about it, it's been so many years. I mean, we're coming up on almost 30 years. You know, I can't remember what I didn't know. I don't even remember what I didn't know. But okay, so you know, we talk about when we invest in the stock market, we think individual stocks. No. I see huge investment firms doing that. You know, if you have $1 million or more, these are the strategies you should be using. I see ads for that all the time, that kind of stuff. And then I look at their portfolios and I go, oh my goodness, individual stocks. Number one, history of returns, not so much, nothing to write home about. Matter of fact, problematic as far as risk goes. But, you know, individual stocks, no, I don't want to be using individual companies because I'm making the assumption those individual companies that I like want to pay more to use my money. When it is typically the opposite. If I like them, that must mean that they're what? They're good companies. They're well-liked companies. They're solid. They're stable. If they're solid, they're stable, they're well-liked, they got a good product, I like going and shopping at their place, or I like buying their stuff. The reality is probably a lot of other people like buying their stuff too. They don't have to pay typically very much to use your money. So those companies that are really popular that we'd be attracted to, matter of fact, when we do group presentations, quite often we'll go, name a company. Somebody just name a company, anybody, any company. Arlene, name a company.
Nvidia.
Yeah, NVIDIA. Yeah, for sure. Okay, great. Name another company.
Apple, Tesla.
Apple. Yeah. Who else? Name me another company.
The Magnificent Seven.
Yeah, keep going. Just keep naming companies.
Netflix.
Yeah,
Exxon.
beautiful.
Chevron.
Beautiful. Okay. And one of the points that we make, this is the type of things that people will say in the audience when we name companies like that. Somebody said to me the other day, Walmart. She wanted Walmart stock. And I said, "Oh, that's interesting. What do you like about one?" She said, "I think it's great. I think it's a wonderful company. I think they're really, you know, they got, you know, people shop in their pajamas and all that stuff. But, you know, they, but you know, I like them. And, you know, and I said, okay, great. What's not to like? Yeah, they keep prices low and a lot of people like to shop there. I said, do you think they want to pay more or less to use your money? And she said, I never really thought about it. And I said, I taught her that earnings yield concept I talked about, where stocks typically sell for 16 times earnings. And when I looked at it, Walmart stock was selling for like 56 times earnings. And she's like going, oh my gosh, the price is really high compared to the earnings. I said, exactly. Now you turn that ratio over. When it's 1 divided by 16, that equals 6.25%. If it's 1 divided by 50, that's 2%. Your earnings yield is actually lower. And she was, oh, wow. And I said, precisely. Individual stocks, It's a great way for Wall Street to make money. They love getting you excited about buying individual companies, but recognize you're letting that company use your money. They want to pay you as little as they possibly can. You want to get paid as much as you possibly can.
Opposite. Totally opposite.
Totally, yeah. We have opposite intentions and opposite goals. And hence, when I buy individual companies, I'm taking huge non-systematic risk.
Uncompensated risk.
Uncompensated risk. That's exactly right. I'm taking risks that I'm not expected to get paid for. I'm going to go and get I'm going to go take an uncompensated job. What?
Now that you put it that way.
I know, that's ridiculous. I mean, why? That's the kind of work I want to do when I grow up, Mom. I want to take an uncompensated job. That's what we're doing when we buy individual companies. Okay, now how do we actually take away that non-systematic risk? Well, we can reduce it significantly by owning commingled investment vehicles. So examples of commingled investment vehicles would be
Index funds, S&P 500.
Yeah, mutual funds. What's another type? Mutual funds would be one. Another one would be ETFs, exchange traded funds. So you mingle your money with other people, commingled, and then we all own the bucket. We buy all the bucket is the mutual fund buying all of these stocks with the money that everybody put in the pool to buy all of these different companies. Now, if we buy an S&P 500 index fund, like Arlene's talking about, you have a pool of stocks of 500 companies. If I buy the Russell 2000, I've got 2,000 companies. If I buy the Wilshire 5,000 index, how many companies do I have? Trick question. It's not 5,000. It's like 3,000 something. But trick question. Then I'll have the Russell 1000 value. Those are out of the Russell 1000, it's a value company. So you might have 500 different companies that are value companies. If I buy the Europe, Australia, Far East, I think it's like 700 and something companies. If I buy, let's say a small cap international fund, it might be, 4,000, 5,000, it just depends on the index, but you'll have different funds that invest in lots of different companies. Now, when I own all 500 companies, the S&P 500, I own all of those different sectors we were talking about. I own energy. I own telecom. I own the energy companies. I own the consumer durables and the consumer staples. I own all of those different sectors. I own it all in one fund. That is an asset class. An asset class, as I like to explain it, is this. It is a grouping of stocks that tend to be affected by the same stuff. So if, let's say, the economy is such that, hey, being really, really big is important at this point in time because let's say I'm able to implement AI technology rapidly because I'm really huge, or I'm able to buy things in bulk. That would be where large companies would do well in that type of an economy, large caps. So that would be an asset class that would be large U.S. stocks. They tend to move like a school of fish. They tend to move together. You watch them and go, who's following who? And that is an asset class that did very, very well when Trump was president the first time. Did extremely well. It was an asset class that did extremely well during the tech bubble of the 1990s. So that is an asset class. Now, another asset class would be small U.S. stocks. Small U.S. stocks, and there's been history, it just changes throughout history. But maybe when technology or things are changing rapidly and those smaller companies can implement the changes quickly, they tend to benefit. Value stocks would be higher dividend paying companies. Interestingly, when have value companies done fairly well comparatively? Believe it or not, this sounds really weird, but they've actually done fairly well during market downturns. Like near 2000, when the S&P 500 went down 12%. You had large value stocks actually go up 10%. In 2001, when large growth companies went down 9%, value went up about 3%. Small value went up like 30. So they just move differently. It's like thinking about now we got this school of fish, and then we got this contrarian school of fish that moves the other direction. And they don't tend to move in lockstep with each other. Because they don't move in lockstep with each other, owning both of them can reduce the risk of my overall investment portfolio. So let's go back to 2000, when large stocks, when growth companies went down 12% and value went up 10. Now, if I had all my money in large growth, I was hurt, man. That was bad.
Almost 50%.
That's kind of rough. But if I own value in there, man, the downturn of 2000 was kind of a non-event. Wasn't a big deal. And if you were diversified that particular year, you really didn't get hit that hard at all. As a matter of fact, you went up slightly in a really well-diversified portfolio. 2001, you went up slightly. 2002 went down after 9/11, but not nearly as much as the S&P 500. S&P went down 22%. Diversified portfolio went down maybe about 7%. It wasn't nearly as much. Went down, and that can happen. But these asset classes, this is when I'm designing a portfolio. What I'm doing is I'm choosing asset classes, large, small, large value, small value, international large, international small, international large value, international small value. I'm choosing them in such a way that I put things together, they don't tend to move with each other. So a little bit about, walk through, Arlene, some other asset classes internationally, some of the things that we'd own, what would we own and types of countries, and what's the difference between established markets versus emerging?
Well, international emerging markets, like Israel. Israel is
sure. Yeah.
Mm-hmm.
Yeah.
And then you have developed markets, international developed markets, which is the Europe.
Yeah, Germany,
European,
France, Australia, Japan.
And then you have Australia. Yeah.
Yeah.
So
those would be developed markets. And the reason they've got a longer track record, they've been around a longer time. But you'll have countries like Singapore would be called emerging because it's been out there. South Korea. Although they're becoming more established, but they're still in the emerging markets portfolio typally.
And Japan is
Brazil would be in there.
And Japan is its own category.
Well, Japan would be in an established market, because it's been around a long time. So that would be in the established markets type of a part of a portfolio. So you get the idea. You'll have international markets that are established, more established, like the Germanys, France's, and Great Britain's, and like Ireland, and countries like that. And then you have the emerging economies that would be a little bit in. And here's the thing about emerging economies you got to be really conscious about. And this is something that we think about when designing a portfolio. We want to make sure your property rights are protected. The reality of it is, if I own stock in a company in a country such as Brazil, would Brazil protect my right to own property in their country?
It's questionable.
It can be questionable. So you tend to underutilize that particular area of the market, really. For that particular reason, that asset class, emerging markets, would be underrepresented in a portfolio or a much smaller piece of the portfolio than established international markets. And that's why. Now, when we choose countries to go in there, what are the criteria that we typically use to choose countries to go in emerging markets? Well, I want to have at least 4 market makers. Remember I talked a little bit earlier about market makers? Walmart, you have Walgreens and Kroger and these different places make a market for Colgate toothpaste is what I talked about. Well, market makers own the stocks, and I can go buy, XYZ company at this particular market maker that holds an inventory in that stock. Well, I want to have lots of market makers in my emerging market. Now, I'm telling you this not so that you memorize this junk, but I want you to know that we know it. This is really important. I've had this. I've taught this before in front of audiences, and they sit there and look at me like going, "Oh my gosh, Paul!" And I go, "No, I want you to know that I know this stuff, because that's really important. Because a lot of times, I'm going to tell you, when I was a regular investment advisor, I knew none of it.
And we consider a lot of things like liquidity.
True.
Uh-huh.
Very true.
I mean, that's one reason why market makers are very important in those markets.
Absolutely. And that is, it's a good point, Arlene, because critical when I own investments. There have been people talking about private equity recently, a lot, adding private equity to your 401k plan. And I'm glad Arlene brought this up because private equity can be very illiquid. And it can be hard to turn your money back, your asset back into cash that you can spend for your retirement. And this is something I think that people are going to learn the hard way when it comes down to it. So keep in mind that this is something that's really, really critical. There's certain types of risks that you can avoid, some that you can't avoid. And one that you can help protect yourself against is liquidity risk. And a lot of assets don't have that type of protection around them. So anyway, this is something we think about. You're listening to the Investor Coaching Show. We're going to get more into, ownership of stock market, investing in stock market, putting portfolios together. We're going to get to that too. How do you put portfolios together based on time horizons? How do you do that? What do you look for at various time horizons? Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. We're back. This is the Investor Coaching Show. Arlene Brown and Paul Winkler here. So what we're doing is we're walking through the basics of investing, the general basic things that you need to know, that we believe you need to know as an investor. You need to know what cash is. You need to know a little bit about bonds, what types of bonds. We talked about that. A little bit about the stock market. Why not invest in individual stocks? We talked about that. You're basically taking a type of risk, which is uncompensated, as Arlene called it, which is exactly correct. Uncompensated risk. I don't want to take risk I'm not getting paid or not likely to get paid to take. And because that's not wise. You don't want to go out and take all kinds of risks that you're not likely to get paid. Okay, so we talk about that, and we talked about commingled investing. We talked about asset classes, breaking a portfolio up into large companies and small and large value and small value, and established international markets and emerging international markets, and having both of those things in an investment portfolio, as well as U.S. stocks, of course. And okay, so Arlene, what else should we be talking about regarding that?
Well, two different philosophy in investing.
Two distinctly different philosophies of investing. Okay.
Okay.
You brought it up. Go ahead.
Free markets fail, which is basically the market fails to price assets.
Yeah, they
Prices,
screw up.
yeah.
It's something selling for $50 that we're really, really smart, and we got this figured out. Like you were talking about earlier, we think that that banking stocks, there was the example you gave earlier, that banking stocks are overvalued and they're going to go down, and that energy was going to go up.
So there are mispricings in the market.
They're mispriced. As the banking stocks are selling for too high, they're going to go down, and it's mispriced. Now, in your experience, and you've been doing this how long? Oh, I know. I put you on the spot.
Many years.
Oh, come on. Get.
Many years. Like almost 30 years.
See, there you go. So you've been around the block. You know this stuff. All right. So in your experience in looking at people's portfolios, analyzing what they're doing, what the investment advisor is doing, or what the company, let's say it's a company 401k plan, how often do you see a strict adherence to markets work the opposite of market failure, or that free markets work, a philosophy being used?
Oh, well, I don't even know if they are aware of those philosophy. Okay.
Okay, so that sounds like a never to me.
And most investors, or most of the clients who come in, they have 401k. They don't even know what they have. Okay, and sometimes
So true.
and sometimes I have to. Do you know what mutual fund is? They don't even know that, and you have to explain that.
Oh, so yeah, they're not even familiar.
No,
they're not
they're
even
not
aware of what's
familiar.
going on at all. Okay.
But the exciting part is when you show them
Yeah.
that, okay, you are not really diversified. You have you have 5 mutual funds, but you have the same stocks or companies inside those funds.
Which is a sign that the market failure philosophy is being used. Because I own several funds with the same exact stocks in it. Why did I buy those funds? I probably bought them based on past performance, which is a market fail philosophy of investing, looking at 1, 3, 5, and 10-year track record, because you're buying things after they've done well when you buy on track record. So that would be a perfect example of that philosophy being used. Yeah.
And then when you mention about the other philosophy, which is based on let capitalism work, okay, when supply and demand, okay, rules the market, the philosophy, then it's like, oh, that makes sense.
It does. It's so funny you say that, because I remember when Fama and French and Singfeld and Wheeler and all these guys that I had studied under, I remember when they would talk about that, they would go, okay, folks, guys, it's a room full of us guys, we're all in there, financial advisors studying under these great minds. And they would say, okay, communism, socialism, communism. It says, where do you find it? And we'd be like, North Korea, us, or Cuba. Yeah, okay. And we would name the countries. And he says, it's also in the investing world with markets fail. Because, and they use that example because what happens with communism and socialism is the assumption is that I have a room of really smart people that can engineer the economy in such a way that we can grow the economy at a faster pace. And that's the idea behind that, is we can get somebody, and China is run that way to a great extent.
China is communist.
Yeah, and they're trying to use free market investing principles to some extent to incentivize people. But, there was that quote that I used last week, and it was a really good quote. I may revisit that, because it was a really great quote from Jamie Dimon. And when somebody talked about how China aren't they benefiting more from what's going on right now? Aren't they really in the driver's seat? Aren't they doing in the catbird seat? Aren't they? And everything? And he goes, oh, that's a stretch. He says that the average per capita GDP in America is like $80,000, and it's like $15,000 there or something like that. I forgot the number. But he says it's ridiculous. To say that they're even near competing with us is a joke. And it's because they're basically, the idea is have the leader of China, have Xi, basically set up, what are we going to develop? What are we going to do? What are we going to pursue? And you might have really smart people out there, but the reality of it is they're not smarter than the general consensus of all people in the
6
country.
billion.
Yes,
6 billion people.
So in general, what happens is that we find that those philosophies bump heads. And in investing, it doesn't work very well. And it doesn't work very well. The problem doesn't mean you'll lose money. You can use a market fail philosophy of investing. And this is why people remain in the trap. They don't realize that they're in a trap. I kiddingly say to people, you have no idea how many people had $100,000 in the 1970s that don't have 70 million today. And they'll look at me like, what? And I go, that's what markets, if you're a diversified investor across all these markets I mentioned, that is what the return has been over that period of time throughout history. And the reality of it is investors they end up with these, and you look at it and you go, well, what's the difference in return? It may be only a couple percent, but over that amount of time, it makes a huge difference in accumulation. And, so what happens is that, and I'll actually show people charts. I'll take the fund that they own and I'll go, let me just show that compared to its benchmark, your fund over the past 10 years. And I'll look, and they'll look at it and they'll go, oh my gosh. And I'll say, that is what's called a relative loss. You didn't lose money. Your money grew. But relative to what the benchmark did, that is the difference between, and I'll show them visually, because when they see it visually with their own eyes, then it becomes real. And that, to me, I think is critical. So good point to bring up there, Arlene. Markets work versus markets fail. We are far on the side of markets work. There are people that would disagree with me. Lots of them. There are people that that go, no, I wouldn't do it that way. They'd be wrong. But the reality of it is, it's like, I love what Jim Wood says, one of our advisors. He says, it is hard to convince somebody, and I'm going to butcher the way he says it. It is hard to convince somebody that their opinion and their viewpoint and their approach to things is wrong when their livelihood depends on it. That's really what it gets down to. If you make your money selling annuities, just as an example, if that's how you make your living, and you're a big, index annuity seller or something like that, I'm going to have a hard time convincing you that that's not a good thing to do, because you make so much money doing it. And if you changed your mind that you didn't think it was good anymore, your whole business model is shot. And that is what we face in the investing industry. When we talk about indexing, Arlene talked about indexing. Mutual funds, a lot of mutual fund companies have index funds. To convince them that capitalization weighting is a problem for investors. That's what most index funds, you'll have equal weighted index and they've got their own problems. But index funds weighted based on the size of the company can be a huge problem from a risk and a return standpoint. But to try to tell a major mutual fund company that that is a problem and have them fix it, it's probably not going to happen, because they make so much money selling those things and convincing people that it's a good thing, because and the marketing message, sounds really good. I won't get into the marketing message today, but there's a marketing message that's really misleading when it comes to it. And indexing works really well in just two asset classes: large U.S. and large international. It doesn't work that well in other asset categories. But you won't see a wholesale move of the investment industry away from that approach, even though from one standpoint it's actually good. It's based on the idea that markets work. But the way they implement the philosophy is a problem. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.